Hi, hello, hi everyone. Welcome to watch back another video with Lighthouse Academy. Alright, so in this video, we're going to continue where we left off for the last three series. So in this video, we're going to study a bit more about technical analysis. Alright, okay, so a quick one before we get started. Okay, if you have not subscribed to this channel, right, please click on the subscribe button. Alright, and the bell button beside it to be notified of the next up and coming video that we're going to have in the future. Alright, so the quick disclaimer. Okay, if this is the first time watching this, right, please pause the video, read through the disclaimer, what is it all about before we get started. Okay, so today we're going to continue the last part of this 4-part training series, or rather learning series about between fundamental analysis and technical analysis. So in this video particularly, we're going to talk about the technical analysis part. Alright, so in terms of technical analysis, there's a whole wide range, a whole big schools of thoughts about how to actually use technical analysis. There can be indicators, there can be oscillators, there could be price action, there could be chart patterns and stuff like that, right? But I just want to touch on the most simplest and the most basic and the most commonly used one thing that most technical traders or investors will actually use to look at. Alright, no matter what type of combination they use, this is one of the things they will definitely use, and it will be good for you as a beginner to learn to use this, to apply this, because it can increase your odds of probability quite fair a bit. Alright, so when it comes to technical analysis, alright, usually what it is all about. Okay, so as compared to fundamental analysis, we know that fundamental analysis you have learned in the last videos. If you have not watched it, right, please click on the link, right, any of the link above and below, alright, just to watch the previous video that was about valuation. Or if not, you haven't, this is the first video of the whole series, go back to the series first one. Then we start talking about economic mode of a company first. Alright? Okay? So when it comes to fundamental analysis, we want to find out how and what kind of companies to buy. Alright? So now in technical analysis, we want to find out when to buy. So when is a good time to buy and when is a good time to sell. Alright? And that will give you an idea through fundamental technical analysis. So from Investopedia, so by the definition of technical analysis, basically it's just about identifying trading opportunity by analyzing the statistic trend gathered from trading activities of the past. Basically looking at the price movement and the volume that was traded previously. Alright, so basically just using statistic data that was actually recorded over the past few trading days, or even by years or by months, to find out what is the likelihood patterns. And using this, they actually evaluate to come up some form of patterns, price movement, or trading signals. And that you give you an indicative of what is the probability that things would likely to happen based on the psychology and actions of the previous trading investors or traders. Right? That's the whole idea. So, and this can be actually applied through during stocks, future, commodities, fixed income, currency, all sort of securities. Alright, so basically just look at it as a whole. Okay, so when it comes to technical analysis, the one key thing you need to have to use is what we call the chart, right? Because that is where all the pricing and all the volume of each day or each period is recorded. So if you look at it, this is one of the free platform I use at tradingview.com. They give you a free charting software that you can use it, right, to actually give you an indicative idea of what some of the particular stocks based on the chart it looks like. So this is just one pure example. Okay, so some of the things you need to take note is when you come to charting, there are a lot of different kind of charting style. Okay, as you can see on the screen over here, there are many different types and patterns of actually displaying the same information but on a different chart model, right? And the most common one that we use, or most investors use, or in fact most traders use as well, is the candlestick pattern. Okay, before we actually talk a bit more about support resistance, just let me quickly run through with you what is the basic of candlestick chart, so that you know what it is, how is it formed, and then when applying support and resistance, it makes a bit more sense for you. Alright, okay, so for a candlestick, it's always, for a period, it usually happens in such a way. Right, at any trading day, it will open at a particular hour, right? When the first data was recorded, there's an opening price that was recorded. Okay, then at the end of that period, there's a closing price that was recorded as well. So during this period, there will be a highest point and a lowest point. Okay, and with that, when it closes, the area between the open price and the close price, that will form up an area, or rather a box. Okay, and in this example, let's say if the close is higher than the open price, it will be represented in a certain color or certain pattern. Alright, in this case, it's just I use green to represent it. Alright, okay. So how about the highest and the lowest point? It will be connected by this line that is joined together with the box itself. Alright, okay. So in this case, when I use a green box itself, I represent it as a bullish candle. Or in fact, besides using green, some of other traders or investors, they use white to represent a bullish. Alright, so this is just a representation, or rather an example of a bullish candle. Alright, so the bullish candle can come in many forms. It can be just with the whole body. Alright, it can be with the whole body without any tail. It could be with a small body, small tail, small body, long tail, longer body where the tail is longer at the top rather than the bottom, right? Or something like the body is at the bottom and have a long top, but it doesn't have a tail at the bottom, right? So this is just one example, right? Some few examples of a bullish candle. Okay, likewise, okay, for the other way, that is when the stock price actually open at a particular period, it close below. Alright, close below the open price. You likewise the same thing. You have the lowest and highest point. These will actually form, right, the bearish candle, and usually represented by either the red or the black color candle itself. Okay, so similarly, this is just few examples of how the bearish candle look like. It can be whole body red. Likewise, similar to what I've shown you earlier on the green bullish candle. The green one is just exactly opposite, just that it's in red. So it's just different color representation. Okay, alright. So when you put all these green and red together, alright, it will form a certain patterns or certain wave in the charting itself. Right, you can see that here it's make up some green, some red. It's always a mixture and combination. Right, so it's just that for that day itself, let's say it's green, it means the market is a bit more bullish. On the red day itself, with a red candle, that day is the market is just generally more bearish. But overall, it's actually form a certain pattern. Okay, right. So the next key thing to need to take note is every candle has a period. All right. So what period are we actually usually talking about and referring to? Okay, right. So firstly, a trading period, it could be represented by a day, a week, or a month. All right. So let's say, for example, a day period. Basically, what it means that each candle is representing a day. Alright, that means when the market open on the first time, you have first opening hours, or first price recorded. So at the end of the trading days, okay, when the market closes, alright, you will record the last price, and that is the close price for the day itself. Okay, how about let's say for a week, the week will be the same thing. Let's say market open on the first thing on the Monday, alright, you have opening price, and then you move throughout the whole week, Monday, Tuesday, Wednesday, Thursday, Friday, and right when Friday the market closes, right, you will record the last closing price for the day, and that will form the candle for one whole week. Okay, likewise for month, you just take the record for the one whole month itself. Okay, alright, of course there are shorter time frame. There will be like the hours candles, there are even the minutes candles. Alright, so security, how you actually use them, when to use them, is as such. Alright, for actually if you are a long-term or mid to long-term investor, alright, not trader, investor, okay, typically you'll be using this range about either the daily or the weekly. Sometimes monthly if you're a super long-term investor. Alright, if not generally you're looking at the day and the week. Okay, if you are a swing trader, alright, take note here, if you are a swing trader, that means you want to take a certain, you want to ride on a certain wave pattern or short movement of a trade, of a movement of a stock or of an ETF. Right, generally you'll be looking at the hours candles. It can be ranged to 1 to 4 hours, depend on are you slightly shorter term or are you rather slightly more longer term focused. Alright, of course, last but not least, you have the day traders who uses a minute because they use it as an active platform to actually do earnings and income. So they are no longer investing, they are trading the market. It's just like how you work on a daily basis. Right, they just that they are actually working on the stock market. So they're just finding opportunity to actually put their money in, get the opportunity, ride the move of the wave, and then cash out from the market. Alright, so typical what they use. So it depends on what kind of style you're using. But for this channel, or for most of our video, right, I will be sharing, will be using mainly on using as a daily and weekly time frame, because we are looking at investors time horizon. One of the reason is also because some of the trades that I'll be sharing with you, most likely because on this channel I actually post on a weekly basis. Alright, so if I'm gonna do it on the minutes or even on hours, sometimes by the time you watch that video, it may not be relevant at all. Alright, so I actually do it on the daily, weekly, so that if you manage to actually catch the video on the week itself, the opportunity might still be valid and you might actually want to take advantage of it. So, like I mentioned earlier, so which time frame to use, it really depends on what is your proficiency, right? Things to know, okay, if you are using the daily and weekly, okay, your risk tolerance and your technical analysis proficiency generally no need to be so high. Okay, you just need to roughly know what are they, because you're using on a mid to long term basis, on a daily or even minutes and hour, short movement of the market is very normal. You are usually you are able to tolerate this kind of short movement noises much easier, and you don't need very high in-depth technical analysis proficiency, right? But of course, as you go up the shorter time frame, the smaller the time frame is, they are more sensitive to noises, to market movement, to market short-term news. Alright, so in terms of that, your technical analysis proficiency has to be very high, okay, so that you know when to actually enter and exit the trade at the right time. Okay, timing is very crucial and important for day traders. Right, so it depends on what kind of style you are comfortable with. But like I mentioned, for this video, for this channel, we are mainly using the daily and weekly time frame. Alright, okay, so next thing, so let's get down into it. Alright, so basically that's and give you a rough idea and overview what candlesticks patterns are, how they actually form up in the chart. Alright, so now we just go to the key part about this video is what is support and resistance. Alright, so basically support and resistance is just a part of analyzing the chart itself. Okay, basically for traders and investors to use to reference to the price of the chart, it actually form or acts as a barrier, right, to prevent the price of the asset from to be pushed to a certain direction. Alright, so it acts as a support and acts as a resistance itself. Okay, so basically in terms of support and resistance, there are three different kinds that most people use it for references. Okay, the first one is the horizontal line, support and resistance. The second one is the diagonal line, or some of us we call it the trend lines. And third, basically the dynamic lines. Actually, most of us will use it or call it using the moving averages indicators to use it as a support and resistance. Okay, so in this video, I just want to cover the first two. Alright, for dynamic moving average, using it as a support resistance, probably I will just do it on the next video. Alright, okay, so how do you actually apply this? Right, let's go through the first one on the horizontal line. So let's take this for example. This is a chart of Coca-Cola. Alright, so if you look at the chart itself without drawing anything, it just looks like a graph itself. Just a line going up and going up, going down, going up and down. It doesn't tell you anything. Alright, okay, but if you have noticed, you realize that once price goes up, it tends to bounce around this area, then it came down, it bounced off this area, it went up, and bounced off this area, then it came down and bounced off it again and go back up to where it is right now. Alright, you can see this somewhere around these two lines. Alright, okay, so you can see that firstly, okay, first thing to take note and to key, I think that most new investors or beginners when it comes to technical analysis make an error in the sense that when we talk about where is your support and resistance line, they're always thinking that it's going to be a line itself. Okay, but it's not. Support and resistance line is always referring to an area or a zone. Right? How big or how small the zone, it depends on each company, each chart itself, because you actually have a reflection and indicative habits of how investors or traders actually actively participate in buying and selling a share of these stocks, and is their perspective as a market as a whole to actually identify what is that zone width for that support and resistance. Alright, so ideally you want to actually draw your support and resistance as a zone itself. Just find the common points that where most of them meet, and this will actually add up to a zone itself. This is what I mentioned, right? Key to take note, support and resistance is an area, it's not a zone. Okay, and the other thing to take note for support and resistance, they are interchangeable when they are broken. Okay, so basically what I mean is now when you come to this point, this zone is actually resistance. Then it broken, it turned to become a support, so it bounced off, become a support, it bounced off, but at this point in time, some news that break this support level, so it went all the way down. So once this support level is broken, now it has become a resistance. So when price hit up, you will try to resist, but at this point of time, there are more buying and selling. It pushed up the price, break the resistance level. So now this resistance has become support. That's where price to push up. It failed, it came back now and bounced on this resistance turns support. So it bounced on this support level, went up and came down and bounced off this support level and go back up to where it is now. So can you see that actually this same zone has been acting as a resistance, support level multiple times. And that is what I mean by support and resistance are interchangeable when they are broken, right? So that's very straightforward. That's how we actually identify and draw a horizontal support and resistance line. So next one, actually what we do is drawing a diagonal support and resistance line, or sometimes you call it a trend line itself. So basically drawing support resistance on the trend line is pretty simple. Basically you just draw two straight lines and you try to connect, alright, as many points that actually meet on the common line itself as much as possible. Alright, your minimum you need is 2, alright, but the more point it touches, it just shows that the support on that resistance line is a lot more stronger and resistant. So you can see that this support line at a point of time is actually very strong. It bounce off this, bounce off this, bounce off this, bounce off this 5 times to make sure that this support line is very strong, right? So as an investor, as a trader, alright, a good point to look at it for entry is when the price actually bounce off here, you enter here. When the price went up, came back down to this level, you enter another position if you are bullish with this particular stock itself. Right, so for this chart in this case, it's actually S&P 500. So you could actually bought into SPY. Over here, here's another opportunity to buy into SPY. Here's another opportunity to buy into SPY. But of course, over here it broke down and it turned all the way down to become a downtrend. Right. Likewise for the top, once we hit the resistance, it will bounce and come down. Hit the resistance, bounce and come down. Alright. Okay, it's always harder to catch the first bounce because you never know when the price will hit a certain level to come down. Alright, but once it bounce off and hit a certain level again, alright, you just know that that is generally where the price resistance is going to be, or price support level is going to be, and you take opportunity over there. In just that at that point, at that spot, the odds of things moving in a certain direction is higher, right? You just increase your odds in that favor. That's all. Alright, so after, like I said, if you draw an uptrend when the line is broken, right, you start forming a downtrend. Alright, for SPY found downtrend, now it's actually still on the uptrend, on the short-term uptrend. Okay, so that is how we actually look at the trend line on the basis. Okay, but when it comes to drawing technical analysis, there's one golden rule. If you want to use this to follow, you must follow this golden rule. Alright, which is always trade with the trend. Right, i.e. to say, if the trend of a chart, let me use this chart again. If the trend of the chart is in this direction, we know that it's moving from low to high, it's on a trend or uptrend, you will want to actually look to buy when it hit the support level, rather than looking for a point to sell, because the move of the selling is a lot short and sharper. It's harder to catch and manage. It might drop halfway and bounce back up again, you never know. But if you're on the buying side, when you buy, you know that you will ride up on a trend on the long run, right? So likewise, let's say it's on a downtrend, you want to sell it because you know that the force or the trend is going to push the price down a lot easier rather than pushing up. Just think about the case of a surfer. Alright, a surfer will always want to ride with the wave so that they can get further, faster, ahead of where they want to actually go to by going with the wave rather than going against the wave or against the current, because there's always a resistance. They can move a bit, but it's always short and they probably get killed a lot easier. Same thing likewise for trading using technical analysis in the market. If you are not with the trend, you are always against the trend, you are going against the strength of the market, right? It's always a lot tougher for you, right? So always go with the trend. So that's golden rule. Okay, right. So just a quick one. So in the summary, all right, basically when it comes to support and resistance, there's 3 ways you can actually get about it. First one is actually draw the horizontal line. Second one, draw the diagonal line, or what we call the trend line. The third one is using dynamic line, which is using the moving average indicators, right? And I will cover this in the next video. Okay, so support and resistance is always an area. Remember, it's always an area. It's not a line, right? Just take note of that. Okay, and support and resistance are interchangeable when they are broken. So if it's a support now, once it's broken, it will become a resistance, right? If it's a resistance, once it's broken, it will become a support level. Okay, so always buy at support, sell at resistance, right? Never do the other way around. All right. Okay, so remember, always follow the golden rule, right? Trade with the trend. All right. Okay, so that's it. That's a quick video about technical analysis that I believe that for any new beginner investors that started learning and want to actually go into technical analysis, this could be one to actually help you to find when is a good entry price to buy and when is a good entry price to sell. Okay, no doubt. In the previous video, we talked about valuation that can give you a rough idea what's the price point to enter. That could work as well. Okay, because you are buying into the value of the company, you are using purely on fundamental, not so much about the price. But we do know that when the price is undervalued, but when it's on a downtrend, it could still get even more undervalued, right? So we just want to know when is the right momentum of a buying chart, which represent the buying momentum and selling momentum of all the investors in the market for any particular stocks or share, right? We want to enter when the momentum is on our side, which is following the trend. All right, so that you are buying undervalued and buying at even cheaper price, or rather in a more sensible price. All right, by combining the FA and TA together, and this will probably give you an extra edge when you come to actually investing in the stock market. All right, so with that, okay, thank you very much for watching this video. I hope you find this video useful. All right, so likewise, please comment on the comment section below. Let me know how you like this video. If you like it, please thumbs up so that I know that this video series that I'm doing is beneficial for you as a beginner investor. You learn something from it, so that I will know I could actually make more this kind of educational video for you, or maybe and your friends, right, to actually learn to start investing, right, on this journey. Of course, if you have any other thing that you would like to know and find out, please click, or rather please comment and type something in the comment section below to let me know what other things you want to find out, right? So that, or rather what other things you want to learn, okay, so that if I have area expertise in that, I can actually cover that in a future video, right, to share more with you from what I know about that segment. Okay, last but not least, if you come to the end of the video and you have not liked and subscribed the channel, please do so. Alright, the description was mentioned right at the start of this video. If not, just click on the subscribe buttons or the any of the like buttons, alright, so that you'll be notified on this channel. Alright, okay, with that, alright, I wish you have a good day, have a good week ahead, alright, and I will see you in the next video. Alright, see ya.